7:23 here on Good Day. When it comes to your money, boring is sexy, at least when it comes to your stock portfolio. Now, when investing, people often buy companies that are in the news or just sound like they'd be a lot of fun to own. But that's not always the best idea. In fact, many of the best companies are downright boring. Certified Financial Planner Joe Bert joins us this morning to talk about that. Joe, let's start with this. Some common misconceptions about stocks. A lot of people seem to get it wrong, don't they?
Well, you know, John, I see an awful lot of folks that think when you buy stock that the money goes directly to the company. When you buy stock on a stock exchange, that money that you paid for those shares goes to somebody else who owns the shares. The only time the money goes to the company is what they call the IPO, the initial public offering.
Okay, so let's talk about these stocks.
Sure.
You hear about some of these sexy stocks, right? And people want to put all their money in it, but those sexy stocks go way up and then they can go way down. Why is boring sometimes better?
Well, because boring means you're probably going to make money and avoid losses. You know, when we're talking about those kinds of things, it's the excitement that we want. You know, we got in on the ground floor on Yahoo or Google or Microsoft or whatever it might be, and when we make that big hit, we feel good. But I'll tell you, for every one of those, there's many, many losers. And you're right, it's the ones that are in the news that get our attention. We want to own some of that, but those are the high-risk, high-reward propositions.
Joe, it's almost like gambling. People always tell you when they won, but they don't mention the several dozen other times when they lost a ton of money.
Exactly, John.
What are some of the boring stocks? Caterpillar is the one that always comes to mind. Nobody thinks about it, but that traditionally has been a pretty decent stock. What are some others?
Certainly, depending on the company. But what you want to talk about is sectors, and you know, some of the boring sectors are banking. You know, there ain't much going on in banking, and utilities. You know, the utility company's always going to be there. So banking, utilities. But the way you want to own those, if you're going to own those kinds of investments, don't own them as individual stocks. Because once again, when you own a stock, it's high risk, high reward. You want to own them in a mutual fund because you get diversification in that. That's what we all need.
Do you like those idea of the date funds where you invest for a 2035 or a 2045? Do you like those ideas?
You know, that's not a bad idea for many people. It's a set it and forget it. Once again, the target date is designed to coincide with your retirement. The closer you get to the retirement date, the more conservative that fund gets. So when you get to that retirement date, the bottom hasn't fallen out. We see that an awful lot in 401k plans. And for those folks that don't understand what they're doing, I think it's not a bad way to go.
All right, Joe Bert. Hey, what's the best way to find you?
Just Google me, Joe Bert, B-E-R-T.
All right, be boring.